After studying this module, you shall be able to understand the meaning and types of corporate debt instruments, understanding corporate bond market in India, identify the yield associated with debt securities, understand valuation and pricing of bonds, interpret the risk and term structure of interest rates. Companies need the funds for expansion, modernization, purchasing equipment, construction of building, etc. For this purpose, they may raise the funds either through borrowing from banks or buying issues securities to public. These securities may be either shares or bonds. While shares represent the ownership interest in the issuer company, bond signifies the borrowing by the issuing company from the general public, which includes wholesale as well as retail investors. Such bonds are known as corporate bonds. Broadly, in India, bonds issued by any entity other than central and state government falls in the category of corporate bonds. Features of corporate bonds: face value and issue price. Each bond carries a face value which may be, for example, rupees 1000. This is the nominal value of bond. It is used for accounting purpose and coupon is calculated on face value. Corporate bond may be issued at a discount, at par, or at a premium with reference to its face value. The price at which a bond is issued to investor is known as its issue price. Fixed maturities. These bonds are issued for a fixed tenor. On maturity date, they are redeemed either at face value, at a discount, or premium based on the terms of issue. Coupon rate. These bonds carry a coupon rate which may be fixed rate, for example 12%, or a floating rate linked to some base rate. For example, a floater bond may have coupons such as 5-year G-Sec rate plus 2%, where 5-year G-Sec rate is base rate and keeps on changing as the rates of central government securities change, while 2% is the spread which remains fixed for the entire tenor of the bond. Coupon payments are made to investors periodically. For example, coupon may be paid quarterly, semi-annually, or annually. Transferability. Corporate bonds are transferable instruments which are listed on the stock exchanges and traded among the investors in the secondary market. Examples of terms of issue of a corporate bond: face value rupees 1000, issue price rupees 1000, that is issued at par, coupon 12% fixed coupon, issue date 1st January 2010, maturity date 31st December 2020, maturity period 10 years. Coupon frequency semi-annual, June and December. Redemption value rupees 1000 at par. Call option not available. Put option not available. Corporate bonds are attractive investment avenue for moderate investors because of the following benefits: higher return in comparison to government securities at bank deposits, lower risk in comparison to equity, fixed and regular income, flexibility and choice as various types of bonds available. Types of corporate bonds. Corporate bonds in India can be classified based on the following criteria: issuer of bond, maturity period, type of coupon, embedded options, redemption methodology, security, convertibility, taxability. Classification of corporate bonds based on type of issuer entity. bond issued by local bodies, bond issued by public sector units, bonds issued by financial institutions, bonds issued by banks, bonds issued by corporates. 2. Classification of corporate bonds based on maturity period. Short-term maturity bonds are the bond issued with the maturity period of less than 1 year. Medium-term maturity bonds are the bonds issued with the maturity period ranging between 1 to 5 years. Bonds with the maturity period of more than 5 years are known as long-term bonds. Bonds which do not have any maturity period are known as perpetual bonds. Third, classification of corporate bonds based on type of coupon offered to investors. Fixed coupon bonds are the bonds which carry a fixed coupon rate throughout the tenure of bond, irrespective of market interest rates. For example, a bond issued at a rate of 12% coupon rate. Floating coupon bonds are the bonds for which coupon rate is linked to some base rate. The overall coupon rate of bond keeps on changing whenever there is a change in base rate. For example, a floater bond coupon may be expressed as 10-year G-Sec rate plus 1%. Here, 10-year G-Sec rate is the base rate and it will change whenever interest rates on government securities change. Here plus 1% represents the spread which remains fixed and is determined by the factors such as the strength of issuer and prevailing market interest rates. Zero coupon bonds are the bonds which are issued at discount to its face value and redeemed at par. There is no coupon payment during the entire tenure of bond. The difference between issue price and par value serves as the interest for the investors. Classification of corporate bonds based on the embedded options of bond. Callability. Corporate bond may be issued with callability feature. This allows the issuer company to call back the bonds from the investors if the interest rates in the market falls below a specified rate. The timing and price at which option can be exercised are specified at the time of issue. The issuer company will exercise this option if they have issued bonds at a very high rate and market interest rates have come down to an extent that by calling back they can reduce their cost of funds even after taking into account the transaction cost of calling back and reissuing fresh bonds at prevailing lower market interest rates. Putability. Corporate bonds may be issued with putability feature. This allows the investors to sell back the bonds to the issuer company during the tenure of bond if the interest rate in the market rise above a specified rate. The timing and price at which option can be exercised are specified at the time of issue. Classification of corporate bonds based on the redemption methodology. Bonds with single redemption are the bonds in which principal amount is paid at the time of maturity in one single payment. Amortizing bonds are the bonds in which borrower pays the interest and principal over the life of the bond. 6. Classification of corporate bonds based on security. Secured bonds. Secured bonds are the bonds which are issued against some collateral. This collateral may be the movable and immovable assets of the issuer entity. In case of the default by the issuer entity, the investor/lender can recover the sum by selling the collateral. Normally, secured bonds are long-term in nature. Unsecured bonds. Unsecured bonds are the bonds which are not secured by any collateral. They are normally short-term bonds with a maturity up to 18 months. 7. Classification of corporate bonds based on convertibility. Fully convertible bonds. Fully convertible bonds are the bonds which can be converted in the equity shares of the issuer entity at the time of maturity at the pre-specified rate. Such bonds are beneficial to company because it does not require to arrange the huge sum of money for redemption at the time of maturity. The investors also get the benefit by receiving the share at the pre-specified rate, while the share of the company might be trading at a higher price as the company would have grown up during this period. Partially convertible debentures. Partially convertible debentures are the debentures which can be partly convertible into equity shares of the company at the pre-specified rate, while partly they could be redeemed at maturity. For example, for a 100 rupee face value debenture, 40 rupees could be redeemed, while for 60 rupees shares can be issued to the investors. Non-convertible debenture. Non-convertible debentures are the debentures which are redeemed in full at the time of maturity. 8. Classification of corporate bonds based on taxability. Tax-free bonds. Tax-free bonds are the bonds on which the return is not taxable for the investors. Taxable bonds. Taxable bonds are the bonds on which the return is taxable for the investors. Corporate bond market in India. Primary market for bonds. Major issuers of corporate bonds in India are public sector units, banks, corporates, financial institutions, etc. Corporate bonds can be issued either through public issue or private placement method. 1. Public issue. When a company is willing to raise the funds through public issue of debentures/bonds, it has to abide by the rules and regulation of SEBI for public issue. The issue will be offered to general public, and the prospective investors will be institutional investors, non-institutional and retail investors. Floating cost of issue will be higher in comparison to private placement. Bond issues has to be mandatorily credit rated by 2 SEBI registered credit rating companies, for example, CRISIL, ICRA, CARE, etc. Rating will imply the credit quality or extent of credit/default risk of the instrument. Rating may vary from AAA to D, where AAA rating implies higher safety and D implies risk of default. Coupon rate offered to the investors will be influenced by the reputation of issuing company, credit rating of instruments, and prevailing market interest rates. 2. Private placement. In this method, issuer entity will directly issue the bonds to one or more institutional investors. The terms of issue will be mutually agreed upon between the two parties involved in the transaction. In India, majority of corporate bonds are issued through private placement method. The floating cost of issue will be much lower in this case in comparison to public issue. Secondary market for bonds. Secondary debt market is not well developed in India, and the trading volume has been quite low in comparison to derivatives and equity market. Gradually, debt market is developing in India. Government and corporate debt instruments are listed on the major stock exchanges, and trading takes place on the platform provided by these exchanges for debt segment. On NSE, the secondary debt market comprises of wholesale and retail debt market segments. while on BSE, trading of debt instruments takes place through Bolt. Various players in secondary debt market includes mutual funds, pension funds, NBFCs, trusts, cooperative banks, etc. Why secondary corporate bond market is not developed in India? Several reasons may be assigned to the less developed secondary bond market in India. From the supply side perspective, major issuance has been from the government and PSUs. Private sector has majorly relied on the bank finance for fundraising. Corporate sector has shied away from tapping the debt market because of regulatory disclosure requirement, high floating cost, and varying stamp duty across the states. On demand side, major investors are banks in the bond market, but they have to comply with SLR requirement. Therefore, their major investments are in the central and state government bonds, and therefore there is less demand for the corporate bonds. The retail investor participation is also low because of low liquidity in the secondary corporate bond market. Retail investors have the preference for FDs, RDs, NSC, and other fixed income instruments over the bond. The steps to be taken to develop the secondary market. The corporate bond market in India can be strengthened by adopting the several measures on the supply side and demand side. Some of them are discussed here. The issuer base in India has been concentrated, where majority of corporate bond issues being floated by BFSI sector entities. There is a need to broaden the issuer base of corporate bonds in India. For this purpose, the bond market has to be made more issuer friendly. Floating cost has to be reduced and stamp duty norms have to be corrected. In order to push the demand side, the pension funds and insurance companies should be given more freedom for their investments. The banks may also be allowed to invest in AAA securities to fulfill the SLR requirements. The taxation norms on the bonds interest have to be made more investor friendly. Liquidity in the secondary market should be improved by introducing market making mechanism, and securitized debt market must be revived. FI's flow in the bond market must be encouraged, and role of debenture trustees must be strengthened to ensure the protection of investors' interest. Retail investor participation must be encouraged. Recent developments in corporate bond market in India. The size of Indian bond market is considerably large, but it is dominated by government bond market. The size of corporate bond market is quite less in comparison to government securities market. This is so because in India, more reliance has been placed on bank loans as a source of funding by corporates. Recently, Indian corporates have depicted the stronger presence in the bond market. As per the CRISIL data, coupon bond market issuance has increased 7-fold over the last decade. Here is a graph which is showing the strong growth in recent years. It has been observed that issuer base has expanded. Earlier in debt market, major issuer was government, and recently the private sector participation has increased in the bond market. Mutual funds and FIs have emerged as the largest investor in bond. Bond yield and pricing. Bond yield implies the return to the investor of a bond given the price at which it is bought. Yield is different from coupon because coupon is fixed throughout the tenure of the bond as it is calculated on the face value of a bond, while yield is a relative term and depends on the price at which bond is traded or is bought by the investor. There are many concepts related to bond yield which are as follows. Nominal yield. Nominal yield is the quoted coupon rate on the bond. It can be found by dividing the annual interest payment by face value of bond. The current yield and nominal yield will be same if bond is selling at its par value. Current yield. Current yield is calculated by dividing the coupon payment by the current market price of the bond. For example, if rupees 1000 12% coupon bond is trading at rupees 1200, then the current yield will be calculated as current yield is equal to coupon amount divided by market price multiplied by 100. So 12% of 1000 divided by 1200 into 100 is equal to 10%. Thus, if the bond is trading above its par value, it results into lower current yield in comparison to its coupon rate. Yield to maturity, in short YTM. Yield to maturity of a bond implies the return to the bondholder if the bond is held till maturity, given the price at which bond is purchased by the investor. In other words, YTM is the internal rate of return, in short IRR, generated by bond investment. It is the rate at which present value, in short PV, of all future cash inflows related to bond becomes equal to cash outflows or current price of the bond, where future cash flows include periodic interest as well as principal amount. YTM is calculated by the following method. Bond price P0 is equal to I1 divided by 1 plus R raised to power 1 plus I2 divided by 1 plus R raised to power 2 and so on up to IN divided by 1 plus R raised to power n plus maturity value divided by 1 plus R raised to power n, where P0 is the current market price of bond, I is the periodic coupon payments, MV is the maturity value, R is the YTM. Example. Calculate the YTM of a 1000 rupees bond with a coupon rate of 10%, maturity of 4 years, if the purchase price is rupees 800. Now this is given by the equation 800 is equal to 1000 into 10% divided by 1 plus I plus 1000 into 10% divided by 1 plus I raised to power 2 plus 1000 into 10% divided by 1 plus I raised to power 3 plus 1000 into 10% divided by 1 plus I raised to power 4 plus 1000 divided by 1 plus I raised to power 4. By solving the above equation, we get I is equal to 17.34%. Thus, when the market price is below the par value, bond yield is higher than its coupon rate. This indicates an inverse relationship between bond yield and price. Yield to maturity for zero coupon bonds. In case of zero coupon bonds, the outflow is equal to discounted price at which bond is purchased, and cash inflow includes only the maturity value as there are no intermediate interest payments. In this case, YTM will be the rate at which the cash inflows, that is the maturity proceeds, equate the cash outflows, that is the purchase price, over the tenure of bond. Pricing and valuation of corporate bonds. Bond prices and interest rates have the inverse relationship. When the market interest rates rise, the newly issued bonds carry higher interest rate as compared to the existing bonds. In such a scenario, existing bonds which are carrying lower coupon loses their attractiveness and they lose their value. Such bonds will command a price below their par value. For example, if a bond is carrying 9% coupon rate, while the market interest rate rises to 11%. In this case, holder of the bond with 9% coupon will be able to sell this bond only if he sells it at a price lower than its par value. Otherwise, there will be no buyers for this bond. In the scenario of declining interest rates, opposite phenomenon takes place. This price volatility is of no concern to an investor who is intending to hold the bond till maturity, because on maturity, redemption amount, which is equal to the face value, will be paid to the investor. However, for a short-term investor, this price volatility matters a lot, and he has to factor in for such price volatility, which is also known as interest rate risk. The relation between price, coupon rate and yield is given below. If coupon rate is greater than YTM, the bond will sell above its par value, that is at premium. If coupon rate less than YTM, the bond will sell below its par value, that is at discount. And if coupon rate is equal to YTM, the bond will sell at par value. It means bonds can sell at par value, at a premium or discount. Bond will sell at a premium if the bond coupon is higher than the average prevailing rate offered on the bonds in the market. On the other hand, bond will sell at a discount to its par value if the coupon offered on bond is less than the average prevailing rate in the market. Bond valuation suggests that theoretically, bond price should be equal to sum of present value of all the future cash inflows pertaining to bond. These cash flows include periodic interest payment and maturity proceeds, where discounting rate should be required yield from bond investment. Default adjusted bond returns. In case of bond investments, YTM is considered as expected bond return. It is the rate at which the cash inflows become equal to cash outflows. This expected return is impacted by the fact that the issuer of bond may default. This default may take place immediately, or it may happen over a period of time as a result of degradation in the financial performance of bond issuer. Yield spread in case of bond investments refers to difference in interest rates of two bonds because of difference in their credit quality. This difference is known as risk premium. The difference in credit quality is implied by the different credit rating of bonds. Yield spread may widen over a period of time on the two bonds with different credit quality. Then it implies that the market is forecasting a higher risk of default on the bonds with low credit quality, and therefore more risk premium is reflected in their interest rates. This may happen during the slowdown in the economy. When there is an expectation of expansion or growth in the economy, the probability of default goes down. This may result in the narrowing yield spread between the bonds with different credit quality. Risk and term structure of interest rate. At a given point of time, there are different bonds offering different rates to investors. Some of these bonds have same term to maturity, while some others have different maturity. An example of structure of interest rates may be as follows. It is in 3 columns: debt security, maturity, yield. Treasury bill, maturity is 3 months, yield is 7.10%. Commercial paper, maturity is 3 months, yield is 8.25%. 10-year government bond, maturity is 10 years, yield is 7.50%. AAA corporate bond, maturity is 10 years, the yield is 8.75%. AA corporate bond, maturity is 10 years, yield is 9.50%. The difference in the rates may be due to different maturities, risk, and issuer of the bonds. The difference between the interest rates on two bonds is known as the spread. The spread is often measured by basis points. 1% equals to 100 basis points. In this example, the difference between AAA corporate bond and AA corporate bond interest rate is 75 basis point. Within bracket 9.5% minus 8.75%. Risk structure of interest rates. When the bonds with similar term to maturity carry different interest rates, then this is termed as risk structure of interest rates. Risk structure of interest rates is explained by following factors. Default risk. Two bonds with similar term to maturity will carry different coupon if they have different degree of default risk. Default risk is the risk of non-payment of interest and principal by the issuer of bonds. Government bonds do not have any default risk because it is assumed that government will never default. While the corporate bonds relatively have some degree of default risk depicted by their credit rating. Bonds with highest AAA rating carry lowest risk of default. Ratings vary from AAA, AA to D, where D implies highest risk of default. It is natural that any investor will demand higher interest on the bonds with higher risk of default in order to cover their risk. Thus, government bonds with same maturity will offer lower coupon in comparison to corporate bonds, which carry varying degree of default risk implied by their rating. The difference between two rates is also known as default premium. In our example, the difference between 10-year government bond coupon and AAA rated corporate bond of same maturity is 125 basis points and implies the default premium. Always, a bond with higher default risk will have higher coupon in comparison to bond with lower risk of default. Otherwise, investors will not subscribe to it. The probability of default increases during the time of recession in case of corporate bonds. Therefore, spread between corporate bonds and government bonds vary over a period of time and widens during the time of recession. Liquidity risk. Normally, more trading takes place in government bond market in comparison to corporate bonds. Thus, government bonds offer more liquidity and hence investor will subscribe to them even at a lower coupon in comparison to corporate bonds, which are relatively less liquid. Tax considerations. In many cases, bonds carry income tax exemptions. For example, some bonds are tax-free bonds. Such bonds attract the investors even if they offer lower coupon in comparison to bonds without any tax exemptions. This could be one of the major causes of spread between the two bonds with same maturity in many cases. Term structure of interest rate. At a given point of time, bonds with different terms to maturity offer different interest rates. When the difference in interest rates on different bonds is caused only by difference in their maturity, this is known as term structure of interest rates. Normally, the interest rates on bonds with different maturity moves together. That means that if rates on short-term bonds are changing, then this will be complemented by the simultaneous change in the interest rates on long-term bonds too. However, short-term rates are more volatile in comparison to long-term rates. If the rates on bonds with different maturity are plotted on a graph with reference to their maturity, this is known as yield curve. Yield curve is normally upward sloping. That implies that bonds with shorter maturities carry lower coupon in comparison to bonds with longer maturities. Sometimes yield curve slopes downwards when short-term interest rates are high. Such a curve is known as inverted yield curve. Yield curve helps us to understand the relationship between short-term and long-term rates and the investor expectations regarding the future interest rates. There are three theories which explain the term structure of interest rates, which are as follows. The expectation hypothesis. The expectation hypothesis is based on the assumption that bonds with different maturities are perfect substitutes of each other. That is, investor does not have any specific preference to maturity of bond. Under this assumption, if an investor has 5-year investment horizon, then investor will be indifferent in buying one bond with 5-year maturity or 5 different bonds with 1-year maturity bought every year over a period of 5 years. If they are perfect substitute of each other and investor is indifferent between the maturities of bonds, then only concern for him is return. If the return on 5-year bond is more than the average of 5 1-year bond, then everyone will hold 5-year bonds. In order to be perfect substitute, in both the cases, investor should be able to earn the same return. It implies that return on 5-year bond should be the average of 5 1-year bonds. So, the yield on 5-year bond should be the average of expected short-term bond yields over next 5 years. This theory helps us to forecast the future short-term interest rates. If the short-term interest rates are low and long-term rate is high and yield curve is upward sloping, then it indicates that market expects short-term interest rates to rise. Then only the average of those short-term rates will lead to higher long-term rate at present. With the help of expectation theory, following observations can be explained. 1. Interest rate of bonds with different maturities tend to move together. This phenomena can be explained by the expectation theory because long-term rates are expected to be the average of short-term rates over a period of time. Therefore, when the short-term rates change in upward or downward direction, their expected long-term average will also change in the same direction. Thus, long-term and short-term rates will move together. 2. Yield curve can slope upward as well as downward. With the help of expectation theory, it can be explained. Yield curve will slope upward when short-term interest rates are low and they are expected to rise, and therefore long-term bonds rates are high. Yield curve will slope downwards when short-term interest rates are high and they are expected to fall, and therefore long-term bond rates are low because long-term rates are average of expected short-term rates. 3. Most of the time, yield curve slope upwards. With the expectation theory, this cannot be explained. There are almost equal incidents of short-term rates coming down or going up. The why most of the time yield curve slope upwards. Expectation theory cannot explain this. Segmented market theory. This theory assumes that bonds of different maturities cannot serve as substitute, and investor perceive these two markets separate from each other. Investor with short-term investment horizon will invest in short-term bonds, while investor with long-term horizon will invest in long-term bonds. In this case, rates of each type of bonds will be determined by their respective demand and supply. There will be large number of investors for short-term bonds because of low risk and high liquidity offered by them. Because of large number of investors available for short-term bonds, the issuer of these bonds may offer them at lower rate, while for long-term bonds, less number of investors is there. Therefore, in order to place long-term bonds, issuer has to offer high rate. This explains why the yield curve is upward sloping most of the time. But this theory is unable to explain why short-term and long-term rates move together if they represent two different markets. Further, it also does not explain why investor preference shifts between short-term and long-term bonds over time, which causes yield curve to slope upward at one time and while slope downward at the other. Liquidity premium theory or preferred habitat theory. This theory assumes that short-term bonds and long-term bonds are treated by the investors as substitute but not as perfect substitute. Investors normally prefer short-term bonds because of liquidity and safety offered by them, while long-term bonds carry higher interest rate risk and inflation risk. Therefore, when investors have to be duped to long-term bonds by the issuer, then they have to be offered higher interest rates. That means if the investor has to sacrifice the liquidity offered by short-term bonds, then he should be offered some liquidity premium. Under liquidity premium theory, long-term rates will be average of expected short-term rates plus some premium. Investors have the concerns about the different rates on different maturity bonds. They don't see them entirely different markets, therefore, they will not let them drift far apart from each other. Thus, investors can substitute two types of bond, but because they don't treat them as perfect substitute, they have some preference for short-term maturity in comparison to long maturities. Therefore, long-term rates or liquidity premium have to be higher than short-term in order to make substitution attractive. Another variance of this theory is preferred habitat theory, which says that various investors have different investment horizon preferences, and if the issuer of bond wants to move them out of their preferred maturity or habitats, they have to be offered higher rates. That is why when majority of investors prefer short-term bonds and borrower prefers long-term borrowing, then they have to offer higher rates on long-term bonds in order to shift the investors out of their preferred habitat. The liquidity premium theory explains all the three observations. 1. Interest rates of all maturities depends upon short-term rates, therefore they move together. If short-term rates rise, then long-term rates also rise and vice versa. 2. Yield curve will slope upward when short-term rates are low and expected to rise and vice versa. 3. Yield curve will slope upward generally because long-term rates will increase if the short-term rates increase or fall slightly. Yield curve will slope downward if only short-term rates are expected to fall sharply. Bonds issued by the entities other than central and state governments are known as corporate bonds. It is an attractive investment instrument for a moderate investor as it offers higher returns in comparison to banks, FD and GSEC along with regular income in the form of periodic interest. Significant features of bonds include face value, or par value, fixed tenure, specified coupon rate, callability, putability, and transferability. Corporate bonds can be either placed by public issue or by private placement to specific institutional investors. Bonds can be classified as long-term, short-term bonds based on their maturity. Some bonds carry fixed coupon rate like 12% per annum, while some others carry flexible coupon, for example, 5-year G-Sec rate plus 1%. Yield on the corporate bond depends upon the purchase price of the bond, remaining term to maturity, and future cash flows associated with bond. Yield to maturity or YTM is the rate at which cash outflows equates to cash inflows over the tenure of bonds. Bond prices vary inversely with the market interest rates. If the market interest rates goes up, then existing bond prices come down and vice versa. Risk structure of interest rates suggests that bonds with similar maturity carry different coupons which may be caused by difference in their default risk, liquidity, and tax treatment. Term structure of interest rate implies that when the difference in bond maturities result in difference of interest rates offered by them. This can be explained by expectation theory, which states that long-term rates are the average of expected short-term rates because long-term and short-term bonds are perfect substitutes. Segmented market theory assumes that short and long-term bonds are perceived as two different markets and investors prefer short-term bonds. Therefore, there is a difference of rates between the two. Liquidity premium theory suggests that investors prefer short-term bond and therefore short-term bonds can be placed at lower rate. In order to place long-term bonds, the issuer has to offer a premium to investors. Therefore, long-term rates are equal to average of short-term bonds plus some liquidity premium.